Welcome back, listeners. My name is Larry Kalvig, founder and CEO of the Haven Financial Group. And if you're just tuning in, you are listening to the Haven Financial Group radio show, where weekly we discuss crucial retirement and financial topics that may not be the most exciting, however important, and then they can make the difference between surviving retirement and thriving through it. And let's continue this conversation on taxes. Lance Larson, our CPA at Haven, and his assistant, Melissa, we're able to help a lot of people, not just in tax preparation, but through the tax planning process that we continue to talk about. Because I always say taxes will affect us at every stage of life, but probably more so in retirement than ever before. And I know that's not an uplifting thing to say, but it's the truth. So let's do the best we can to minimize the amount of taxes, and let's do what we can to figure out what makes the most sense for your situation, complicated or simple.
Sure. Lance, I think one of the first things we really need to establish with folks is that tax season is not just between January and April 15th.
No, it isn't. That's the tax preparation season, but the tax planning, that's actually all year. And more specific for me, anything after April 15th and to the end of the year, that's when I spend the most time doing all these planning with clients.
Sure. So when someone comes in and they want a tax plan, where do you start? What do you do?
My first question is kind of what is their lifestyle like? What's important to them? So I can come up with a whole bunch of different strategies. One of the best ones for retirees that are age 70 and a half or older, you can do a qualified charitable distribution out of your IRA. That helps reduce what your future RMDs could be, and it also gives money to charity. It's a great tool, but if charity is not really high on your list, why would we want to use that tool? So this is why we need to understand what's important to our clients. And so we'll have a good 5, 10, 15-minute discussion of kind of what's important to them, what's their lifestyle like, what's going to happen. I hate saying it this way, but the easiest way to avoid paying taxes is to have very low income. Well, if you have a lifestyle that requires a high level of income, well, I can't give you a low income because now you're not going to be having a nice lifestyle.
Sure, absolutely. And, a lot of people, once they are over 65, there's not a lot of write-offs. There's not a lot of, I know there's a senior tax out there, a deduction for being over 65, correct?
Yes, this actually is brand new thanks to the One Big Beautiful Bill that was signed into law on July 4th this year, that people who are going to be age 65 and older by the end of 2025, you will get an additional $6,000 per person. So a married couple can have an extra $12,000 of an extra deduction in addition to their standard deduction. So for a married couple, both over 65, their standard deduction will be $34,700. Then they get this extra $12,000. Now they're writing off almost $47,000 of income, no questions asked.
Right, which is important to a lot of seniors. No two ways about that. Talk a little bit about what harvesting is as it relates to taxes.
So with tax harvesting, this is when you have an after-tax account that you've invested. You take your money that you've earned, paid the taxes on, and you've bought stocks with it. Sometimes stocks go up, sometimes stocks go down. Well, tax loss harvesting is when you look at those stocks that have lost money for you, and you can sell them at the end of the year and to have a capital loss. We use that to help offset other capital gains that we may have. And so then we kind of net those out there. And then we could also use up to $3,000 to write off against your ordinary income. Okay. So this is a nice tax strategy to help when you're trying to rebalance a portfolio that in retirement, before retirement, you were in the grow. So you're okay. You're going to write it out for the long term. So you can buy that stock and it's going to go up and then it's going to go down and you don't care. But once you get to retirement, now we need to be a little bit more conservative about it, because if the market goes down, Now the value goes down. We don't like that. So when we've bought the stocks way back in the day and now we have these big capital gains, well, we have to pay taxes on that. And that happens when you want to rebalance because it is an after-tax account. We don't have that qualified status like we do with your retirement accounts, your 401k, your IRA.
Mm-hmm.
So when we're rebalancing, we're trying to get out of those risky stocks. Well, let's sell some of the losers as well. So then we have less of a capital gain that we have to worry about. And then we can rebalance everything into a more balanced approach. So then retirement, if the market does go down, that you're not going to be hurting as much as you would prior.
Sure. Which again, folks, these are things that maybe sound a bit confusing, but would not be confusing if you sit down with a partner who can walk you through your specific situation. I want to talk about executing Roth conversions. Is this the best time of the year to do it?
It is. The reason being is that now that we're in December, we're looking at it and saying, we know what our income was for the last 11 months. It is really easy for us to say what our income is going to be for the last month. So we have a really, really good idea where your income is going to be at on your tax return. Versus if you try to do it in February, we only have 2 months worth of data. We have 10 months worth of life to happen. And there's a lot more variability with that much life happening. So this is typically why we look at these conversions to do them in fourth quarter. And the nice thing is that when you do a Roth conversion in the year, whether you do it in first quarter or fourth quarter, every conversion is deemed to have been done as of January 1st of that year.
Awesome.
So it doesn't really give you any incentive to do it earlier than fourth quarter.
Except that maybe it's just hard to see you in the fourth quarter, right? Because you're
Our
so
calendars
busy.
do fill up.
Yeah, I'll bet so.
And Kim, I have to add, what he said is completely accurate. But now there's a reason why we're having these conversations throughout the course of the whole year, specifically at the beginning of fourth quarter. But now we're into December, okay? There's the element of time, and there's the timeline. Yes, I know that December 31st for Roth conversions is the deadline. December 31st, qualified charitable distributions, et cetera. We don't want to wait till December 31st because it's not going to get done. Our deadline is really December 1st, which is already passed. I get it. Our drop dead deadline is December 15th because the end of the year, I know human nature is procrastination. After that, it's not going to get done because there's processing time. QCDs take a little longer. It's why we want to have a proactive conversation. We can't wait till the end of the year to get this stuff done and executed. So that's why this is an ongoing conversation. There's a timeline, and we got to follow it. We can't wait till the last second.
Mm-hmm. And Lance, let me ask you about Medicare premiums and what the end of the year means for that.
So what you want to be sure is when you're doing these income planning, that Medicare, there are thresholds, just like tax brackets. Unfortunately, with these thresholds, they are cliffs. So that if you go $1 over, now you are going into the next bracket for IRMA, and you're going to get that extra charge on your Medicare. From a tax perspective, if you go in over by $1, not that big of a deal because it's only that $1 that's going to be taxed at that higher rate. Versus IRMA, you go $1 over. If you were at the base tier where you're just paying that $185 a month or whatever it's going to be next year, you go $1 over, you're going to be hit with an extra 40% of the cost on that one.
Wow.
You get into that second tier, that 40% jumps to 100%. It doubles. So this is why you want to be careful of what your income is.
And that's something that really needs to be addressed by year's end.
You want to make sure that you're not going over. And so that's why the year-end planning is so important.
Yes. For the following year, for 2026, you'd want to be planning that right this minute. Right. Absolutely.
Kim, we have seen this cost people lots of money on Medicare premiums by trying to do the right thing, working with somebody that only does one thing, which maybe is investments. Oh, this is a good idea. Let's convert $200,000 from IRA to Roth. Hey, we like Roth conversions if they make sense, but we have seen that cost people lots of money on the Medicare premium. So that's why the coordination of your CPA, tax preparer, your investment, and your insurance person, your estate planner, they should be coordinated in retirement more than ever. They should be working together. And unfortunately, we see it working in different directions. And it's why the goal 10 years ago, because Haven is celebrating our 10-year anniversary. We're proud of it. I can't believe 10 years has passed. The goal 10 years ago when I started the company was to have multiple personalities in all these retirement areas. And thankfully, that has come to fruition. And it's so very, very important. And I love the compliment that I get weekly. Wow, it's so nice to have all these retirement topics under one roof with multiple personalities that communicate and talk to each other. Boy, it's really effective and it's working really, really well.
Well, congratulations to all of you. And I know it is working very, very well. As we close out this segment, I just want to remind people that we are here at the end of the year. And there's a lot of deadlines. You've heard both Larry and Lance talking about it. And it's hard to keep track of all of these things, and you need a partner to do so. Your situation is unique. And so it's really important that you sit down with someone and talk about your specific needs. Maybe you've missed some deadlines in 25, but 26 is around the corner, and you want to make sure that you don't miss those deadlines again. Give them a call at Haven Financial Group at 612-504-8400. That's 612-504-8400. Lance Larson, thanks so much for being a part of the show. Appreciate your time.
Thank you, Kim.
You bet. Stay with us, everybody. This is the Haven Financial Group Radio Show.